Hello, my name is Chris Cordova. I'm the Financial Wellness Coordinator with Foundation Communities. Today we're going to be talking about managing debt. So let's go ahead and begin by answering the question, what is debt? Understanding your debt is the first step to managing it. So what is the difference between credit and debt? Debt is not the same as credit. Debt is money you owe. Credit is the ability to borrow money. So you use credit to borrow money, which then becomes your debt. We want to now take a look at debtors and creditors. What is the difference between a creditor, and a debtor? So debtors owe money to creditors or lenders. So I myself am a person, I'm a consumer, and I owe money to financial institutions or banks, which would then act as my creditors or lenders, the people that lent me money, the people I went to in order to receive money. So debtors owe money. They're the ones that borrowed it. That would be me. Creditors and lenders are the ones that owed the money. So those are going to be your banks, your credit unions, your financial institutions, and your credit card companies, the people that lend the money out to individuals that need it. So we're going to talk about understanding your debt. In order to understand your debt, you need to know who you owe, how much you owe them, how much the payments are, and when the payments are due. Those are the key items that are going to make you successful to pay back the money that you borrowed. So let's just talk about why people get into debt. And they get into debt for many reasons. Individuals purchase assets such as homes or vehicles. They pay bills, or as a result of not paying them. They're covering unexpected expenses or emergencies like accidents or maybe medical bills, or they're buying something they want or need. So how debt can affect your financial situation? You need to use your future income in order to pay your debts. That means you're telling your lenders, I promise to work for the next 5, 10, 20, 30 years in order to pay you back for the item which I am receiving right now. These are called obligating future incomes. You're saying, I am obligating any money I'm going to earn in the future in order to pay you back for the goods you're giving me today. Generally, pay interest and sometimes fees on your debt until they're paid. So not only are you paying the amount that you agreed to, you're also paying interest and additional fees on top of that. So the vehicle that might be listed for $15,000 may actually be about $22,000 by the time you pay all your interest and fees on it. Many impact how soon you can achieve your goals. And this may impact how soon you can achieve your goals, because that's not giving you, they're usually giving you a time period. And if you want to set another goal aside for the future, you have to keep in mind that you're going to have to pay these individuals off before you can move on to that next goal. So remember, the key takeaway for this first section is understanding your debt is the first step in managing it. These are the things you have to kind of keep in mind before you take out future debt. So now we're going to take a look in section 2 on how debt works. So our key takeaway here is consider how debt works so you can make informed decisions about it. We're going to take a look at the life cycle of debt when you first get into it. So you usually take on the debt, you pay on time and as agreed, and this means that you're staying current. And you're doing that until that debt is eventually paid off. For example, I'd like a car. I don't have the full $15,000 to pay for it right now. So I'm going to agree to pay a specific amount for an agreed amount of time for maybe a number of years until it's completely paid off. So this is the life cycle of a debt when I am not current with it. Previous being current is staying on top of it and paying every month. This is when you don't pay every month. So you take on the debt, then you possibly miss some payments, which is referred to as being delinquent. Now, if you never pay that off or you're never able to make those payments, you're considered to be in default. You are then, that default status can then go to a charge-off, which can lead to collections, which is assigned or sold to a debt collector. And this is a situation that you want to avoid. So when we're talking about various types of loans that we're taking out, there is usually a few terms that we want to be aware of. Now, when we're referring to an installment loan, that is similar to taking out a loan for a vehicle. There's the principal amount that you borrow. So that is usually the price of the vehicle. Now then there's the term, and that's how long you have to repay the principal and pay the interest. They usually give you 3 years, 4 years, 5 years, possibly 6 years. So that's just the amount of money that you're paying each month before you pay that off. Now, generally, you pay the same amount every payment unless there is a variable or adjustable interest rate. You want to really try to find a fixed interest rate. You don't want that to be changing on you as you go along. Now, a different type of loan that you can take out is referred to as revolving credit. This comes with a credit limit, the most you can borrow. This is ordinarily in the situations of credit cards. So in the situation of credit cards, there's usually a credit limit associated with that. And they give you a limit on the amount that you can use on that, on what you can borrow. There's usually a payment based on the credit that you have used. And there's usually a minimum payment. And that's often 1% to 5% of the outstanding balance. That's usually your minimum payment of how much you have to pay off every month. Now, it is a good idea to pay more so you can pay off your debt sooner. And the sooner that you pay off your debt, the less interest you're paying over time. Now, fees, there are the additional charges. They are not interest. Make sure you understand the fees you will be charged and the fees you may be charged. So if you make a payment late, you may be given a fee. If you overcharge on your card, there may be a fee. So these fees are additional monies on top of the interest that you're paying on top of borrowing on that loan. Now, there is a prepayment. There is an early repayment of all or part of a loan, and this reduces the interest costs that you pay in general, and may mean an earlier payoff date as well. Ask if there are any fees for prepayment as well. Sometimes there may be fees associated because that's how some lenders make the majority of their money, is through the fees. Now, not paying debts, what can happen if you don't pay your debts on time or as agreed? Several things can happen if you don't pay your debts: late fees or more money in interest, you're going to get contacted by debt collectors, losing services or paying costs to reestablish the services that you're already receiving, or losing the collateral, if you had a secured credit card, you may lose the money that you initially put up, or if you had an item that you put up as collateral, it may get repossessed and you will no longer have access to it. Some other things that can happen are negative entries on your credit reports, a drop in your credit score, lawsuits from creditors, wage garnishments, account garnishments, treasury offsets. Remember, the key takeaway here is considering how debt works so you can make informed decisions about it. You want to make sure that you know exactly the terms of the loan and of the agreement that you're getting yourself into, so you're not surprised or you're not given a consequence by not being able to pay that loan back. Now, we're going to talk about reducing debt. And our big takeaway here is to develop a plan to reduce your debt and to get help if needed, such as from a trained credit counselor. So once you have established debt, there are two strategies in ways to paying it back or to reduce the debt. There's going to be your high cost debt first method, which you're paying off. You're going to first pay off the debt which has the highest cost to you. The second is called the Snowball Method. You first pay off debt with the lowest balance, and then you pay that off. Then you go to your next credit card, your next car, whatever the debt is, and you just try. You're going to pay your minimum balances on all your other cards, but then you're just going to concentrate on reducing the debt until it's paid off. Now, this is up to you, the method you would like to use. You can give us a call and you can work with one of our financial coaches for free, and we can go into a little bit more information on how these work. Now, a high cost debt first method, the advantage of that is by saving money. The disadvantage is progress may feel very slow. So what you're going to do is you're going to list all your debts, the high cost to you to the lowest. So you're going to just list all your debts out. Let's say you're going to have your student loan that might be $50,000. You're going to have your vehicle that's $15,000. Then you're going to have some credit cards that might be $2,000 or $1,000. So you're going to figure out which one it's going to be the best to pay off first. You pay an amount due on each debt. You make extra payments to the first debt on your list. After you pay off the first debt, you make extra payments on the next debt on the list, and you continue as needed. Now, when it comes to the snowball method, the advantage here is you make progress much faster. The disadvantage is you may pay more money over the long run, but you list your debts out, lowest balance to the highest, and then you pay the amount due on each debt. You make extra payment to first debt on the list. After you pay off that first debt, you make extra payment on the next one until you continue as needed. Therefore, you're eliminating all your debts as they come along. And so the idea there is you're making minimum payments, and then you're aggressive with your lowest. So that's no longer part of your monthly expenses. So places you can find help, you can contact us at Foundation Communities for financial coaching appointments, or we can talk you through these for free. You can go to a nonprofit credit counseling organization. You can go to www.usa.gov and search for credit counseling and tips from the Federal Trade Commission on how to find and choose a credit counselor. So, it is important that you do choose help carefully. There are debt settlement companies. They offer to make deals with your creditors. Ask about their fees if you do decide to use one of these organizations, and about the process that they do go about things and what that might mean to you. And there's also debt consolidation loans. So one loan is used to pay off multiple debts. Ask about interest rates, fees, and other costs. This is probably going to, instead of paying interest rates on 4 cards, you're narrowing it down to 1. But the way this changes is your monthly amount may be a greater amount. But like I said, it's up to you to really investigate, but we can help you make sure that this is a good option for you. Remember, the key takeaway here is to develop a plan to reduce your debt and get help if needed, such as from a trained credit counselor. Now, understanding the high cost of debt, what we want to make sure our takeaway here is that how high cost debt works and identify lower cost options for the future. What is high cost debt? That's the result of small dollar short-term loans with costly fees or high interest rates, or both. There are risks and benefits of all financial products and services, including high cost debt. Some of these are also referred to as predatory lenders, such as car or vehicle title loans. Then that's a loan for a small amount of money for a short time. The title of your vehicle is the collateral. Single payment loans are often due within 30 days, and they can be very expensive. So you definitely want to take a look to find out if the money that you're receiving is worth the amount of money that you're going to have to pay back, because you're putting your paid off vehicle as the collateral to saying, I'm going to pay this back, and if I don't, you have access to owning my vehicle if I'm not successful with paying you back. Now, on top of that, there is the payday or payday advance loans. And this is how these start. The borrower, that would be you visit the payday lender in person or online to get a new loan or borrow or reborrow a prior loan. The borrower gives a lender a personal check dated 14 to 30 days in the future, or it gives permission for an automatic withdrawal from a checking account. The lender then gives the borrower the amount of the loan. When the loan is due, if the borrower doesn't have money to cover the check or withdrawal, the loan may be reborrowed with more fees. So to kind of put this a little simpler, you're going to go borrow money at a very high interest rate. You're going to give the lender access to your bank account so they can withdraw the money. If you're not successful with paying that back in 30 days, they will then try to get you back into another higher interest loan that you can then pay back. You should be very cautious, and you should avoid these types of businesses because it becomes a cycle and a trap that you never get out of, and they can be very hard to pay off after time. The interest rates that you're paying are usually extremely high, and you would probably be able to get a better rate if you went to a more traditional bank. So therefore, payday loans are also known as predatory lenders because of the high rate of interest that they're charging you, the consumer. So please be very wary and very cautious of trying to use these businesses in order to get out of debt. Now, pawn shop loans are also in the business of lending money at a very high interest rate. The item you pawn is the collateral. The loan amount usually is 25 to 50% of how much the pawn shop considers the item to be worth. You repay the loan, renew it, or lose the item. Remember, the key takeaway here is understanding how high cost debt works. Identify lower cost options for the future. You really want to understand the term of the loans and the term of the interest rate that eventually you're going to be paying back, because the $300 you may be borrowing, you may end up paying $600 to $700 to the organization, to the business, just for borrowing a small amount of money. So now it's time to take action and ask yourself, what will I do? How will I do it? And will I share my plan with anyone else? If so, who? You always want to share your plan with a trusted individual and make sure that they're holding you accountable. Now, if you'd like more information on anything that I talked about during this video, you can give us a call at Foundation Communities at 737-717-4000, and you can make a financial coaching appointment, and we would be glad to help you and answer your questions. My name is Chris. Thank you very much, and we'll talk to you soon.